Okay, so now we're going to talk about more specific inventory methods. We're going to start with perpetual inventory, and we're going to use the FIFO method. So first in, first out. I'll type the whole thing out, I guess, since it's our first time talking about it. First in, first out. Oops. First in, first out, which is FIFO, and we're going to use the perpetual inventory method. So how this book works, which I think is kind of nice, they give you one set of information, one piece of information about what the company had, what they bought, what they sold, and then they have you do all 6 of these methods, FIFO, LIFO, and weighted average in both perpetual and periodic inventory in order to show you how the cost flows differently based on the method that I'm using. But the actions that are actually occurring, the transactions that are actually occurring are all the same for all the different methods. So you'll see how it differentiates between them and how it changes, you know, what my cost of goods sold is, what my inventory is. So first and foremost, I have inventory on January 1st. This would be my beginning inventory. This is what I started the year with. I didn't buy this. I bought it last time frame, whatever that might be. So that would be my beginning inventory. So I'm going to put that down here. Real quick, let me explain this spreadsheet. So I have 3 major areas of the spreadsheet. I have purchases, so this would be stuff that I'm buying. Cost of goods sold. This is to record how much I bought the inventory for, and how much I am recording as an expense. Recording as an expense for my cost of goods sold. Remember our journal entry, we record our inventory and our cost of goods sold. And then the inventory column is a running total of how much I have in inventory at any given time. So date, we got January 1st, and this is my beginning inventory, so it's not a purchase. I'd already purchased it in the last year. I didn't sell anything, so I don't have cost of goods sold. All I have is my 1,000 in inventory. My unit cost is $20 per unit, and then I can just multiply the 2 to get my total cost of $20,000. So on January 4th, I made a sale, and I sold 700 units, and I sold them for $30 each. Now I want you to notice something. Nothing down here talks about revenues. So I'm recording these, this $30 per unit, that would make a difference if I'm doing a journal entry, and I would need that if I'm doing a journal entry. But just for what we're doing here, just keeping track of inventory, we're only keeping track of the asset side and the cost side. So I don't actually really need to do anything with that $30 per unit. That's only if I'm dealing with the revenue side of this, and really I'm only dealing with inventory and cost side, assets and cost side of this for this particular exercise. So I'm going to go down here, and I'm going to say January 4th. And what I do, I sold some, so I don't have anything under purchases, but I sold some, so cost of goods sold. Now I'm using FIFO. Now, since I only have one set of inventory, it really doesn't matter what method I'm using at this point. If here in a minute, we'll have multiple layers of inventory, and you'll see that it does make a difference. But for now, it doesn't. I'm also going to, just to kind of differentiate, I'm going to highlight the different dates because it'll get a little bit complicated, because this over here in inventory is a running total. So my cost of goods sold here, I sold 700 units. My unit cost, I only have one set of inventory, so it's $20. It's what I paid for the inventory that I have. So my total cost is 700 times 20, or $14,000. Now what this is over here, what this column over here represents is the running total of what's in my inventory. So on January 1st, I had 1,000. Now I sold 700. So how many do I have left? Well, I had 1,000. I sold 700, so I no longer have that 700. So 1,000 minus the 700 gets me $300. I still have the same unit cost I had before, because I only have one layer of inventory. And so I have $6,000 worth of inventory left. All right, so let's do our next date here. January 10th, it says I purchased 500 units at a cost of $22.40. So January 10th. Purchases, this is the first purchase I've had. So I buy 500 units at a cost of $22.40 each. So my total cost, I just multiply the 2. Okay, now here's where it gets interesting. This is a running total over here, and that's why I'm changing the colors to try and make it a little easier to see. So after I buy this inventory, I have a total of 800, but I have two different costs for them. So I need to keep them straight and list them on separate lines. So what I have in my inventory after this purchase, after my purchase on January 10th, is I have 300 units at $20 a unit, which is the old inventory, the inventory from January 1st. Okay, this inventory here, I have 300 left. And so for a total of 6,000. And now I have new inventory. I have 500 units at a cost of $22.40 each for $11.2. Now, if I just ask you total inventory, you add these two together, and I'd have a total inventory of 17,200. If I ask you total quantity of inventory, I have 800. But I'm keeping them separate because when I sell something using my method, first in, first out, I need to make sure and sell the oldest stuff first and attribute the cost of the oldest first thing. So how does that work? Well, luckily we've got one here on January 22nd. January 22nd, I have a sale of 360 units. So I'm using FIFO, so first in, first out. So the first ones I bought were these 1,000, which is now this layer here, a total of 300 left. The problem is I don't have 360 of them. I have 300. So I'm going to sell all of that layer first, $20 per unit, the cost. So the first in, first out, so those are the first ones I sell. And then I'm going to have to take 60 from this layer too, because 300 now are gone. I've sold them all, but I need another 60 for this particular sale. So I'm going to take 60 out of the layer of inventory that I paid $22.40 for. Now, my cost of goods sold in total is a total of those two, $7,344. But notice I've taken it from two different layers. And I took first from the first layer because it's first in, first out, and the second part I took from the second layer because that's all that I had left. So oldest first, and then for FIFO, and then continuing on. So now over here I need to figure out what I have left. Well, this 300 is gone, right? So I no longer have that layer, and this 500 I don't have all of it. I had 500, and then I sold 60 of it, so I have 500 minus 60 remaining, 440 units remaining at that price at $22.40. So my remaining inventory is $98.56 currently. Okay, now January 28th. Separate my dates here again, just to make sure it's clear that it's a different day. January 28th. I sold at $30 per unit, another 240. Well, I only have one layer of inventory, so I don't need to worry about, going backwards or anything. So sold 240. My cost, I've only got one cost available in my inventory, and that's at $22.40 each. So my cost of goods sold is $5,376. Now, how much do I have left? Well, I had 440, and I sold 240, so I can subtract those two. I have 200 units left. The cost of each unit is $22.40, and figure out what my inventory is. So on January 28th, after this transaction, this is my cost of goods sold. I have $4,480 worth of inventory remaining. And then on January 30th, my final one, January 30th, I purchased 600 units for $23.30 each. Total cost of $13,980. And now I have the old inventory, 200 times $22.40, and I have the new inventory that I just did, the 600, and then 600 at a cost of $23.30 each, multiplied out gets me $13,980. Now, a couple of important things. Let me get rid of some of these here. Just hide them for now. If I'm doing a total cost of goods sold, I'm going to total up the entire column. Why? Because cost of goods sold is a expense account, and expense accounts we do it for periods of time because it goes on our income statement. So that would be my total cost of goods sold is going to be $26,720. But if I said my total inventory, really what I mean is my ending inventory. And that is an asset. An asset, we need to know what it is right now. It's not something I total up this whole column, because remember, these are all running totals. So my ending inventory, I do need to total up two things because I have two layers. I need to total up the inventory I have remaining from prior purchases, and then that most recent purchase on January 30th. So my ending inventory is 18,460, and that's the total of just this 4480 and the 13,980, and that is first in, first out perpetual inventory for all these transactions. And again, this spreadsheet is only dealing with the cost and inventory side of this, not the revenue side. So that's all. Cost of goods sold, total ending inventory. And we'll continue with the next. I think we'll do LIFO perpetual next.